There is 100 trillion market that determines what every dollar in your pocket can actually buy. It decides the interest rates on your mortgage, shapes the return in your retirement account, impacts hiring and layoffs, and can even affect the price of Bitcoin. It's not the stock market, it's not cryptocurrency, it's the bond market, and it's the foundation holding up the entire global financial system. Bond in simple terms. Picture this, you got a business idea that could change your life. You have worked out a plan and you're confident it can make money and you're ready to get started. But your savings account has only $1,000 in it and you need $50,000 to get going. You ask an investor or a bank for the money. The agreement is simple. You give $50,000 now and I will pay you back in 5 years plus interest every year until then. That interest is your thank you payment for letting you use their money. It's also the lender's protection against the risk that inflation will make that money worth less by the time they get it back. The same concept applies on massive scale in the bond market, except instead of 50,000, the numbers are in billions or trillions. From personal loans to global finance, most people understand borrowing when it comes to a car loan or a mortgage. You can take the money now and pay it back over time, and the lender charges interest. The bond market works the same way, except it connects the biggest borrowers in the world, governments, multinational corporations, with the biggest lenders, banks, investments, funds, insurance companies, and sometimes ordinary people. When you buy a bond, you are the lender. You're not taking a stake in the business like with stocks. You're lending money in exchange for a fixed payment and the promise of your full investment back at the end. Governments, spending, and borrowing. Let's zoom in on the US government. Its budget covers things like salaries for soldiers and teachers and government workers, building and repairing highways and airports, Medicare, Medicaid, and Social Security payments, research, technology, and innovation grants. These programs and services cost more than the government collects in taxes most years. So where does that extra money come from? By issuing the US Treasury bonds. How much money are we talking about? In 2024, the US brought in roughly $4.92 trillion in revenue, but spent about $6.75 trillion, leaving a gap of $1.8 trillion. That gap is the budget deficit for that year. Every deficit adds to the national debt, which now sits about 36 trillion. Imagine if you spent more than you earned every year for 20 years. The total you owed would be your personal version of the national debt. How bonds are sold to raise money. The US Treasury don't go door to door selling bonds. Instead, it runs auctions. Big investors like JP Morgan, Vanguard, or foreign governments like Japan and China bids on those bonds. Why would they want them? Because US bonds are seen as a safe bet. The United States have never defaulted and the government has the power to tax and even print money to meet its obligations. Key bond terms you need to know. Let's break down the language so it's crystal clear. Issue date, the date the bond is sold. Face value, the bond principal value. Bond maturity date, the date you get original investment back. Coupon rate, the fixed interest payment each year. Think of it like the rent the borrower pays you for using your money. Principal, the amount you invest or the amount borrowed. Yield, your actual return, which can change if the bonds market price changes. Real life price and yield example. Say you buy a $1,000 bond that pays you 3% interest and that is $30 per year. A few months later, new bonds are paying 5%. That means $50 a year. Your bond interest rate hasn't changed, but compared to the new one, it's less attractive. To sell it, you might have to accept $900. So you're still getting the $30 a year, but now $30 on $900 means a yield of 3.33%. Why interest rates change bonds value? Interest rates are like the tide in the bond market. When they rise, bond prices tend to sink. When they fall, bond prices float higher. Rates are set largely by the Federal Reserve and influenced by economic conditions. If the Fed raises rates to fight inflation, new issue bonds pay more interest. that makes older, lower-paying bonds less valuable in the open market. While the United States is sensitive to rate changes, much of the 36 trillion US debt is in short-term bonds that mature in 6, 12, or 18 months. When these mature, the government issues new ones to replace them at whatever the current interest rate is. If today's rates are high, the cost of refinance balloons. That means a bigger share of the federal budget goes just to paying interest, leaving less for services and investments. The debt to GDP ratio compares the total debt to total yearly income. For a country, GDP is a total production in a year. For you, think of your annual salary. If you make $50,000 a year, you owe $50,000 in debt. Your ratio is 100%. If you owe $100,000, it means 200%. A higher ratio doesn't automatically mean disaster, but it does mean less flexibility and more vulnerability to interest rate changes. Why yields matter to regular people. Bond yields set the baseline for interest rates everywhere. Mortgages, if the 10-year treasury yield rises, fixed mortgage rates usually follow. Car loans, higher yields make auto financing more expensive. Credit cards, rates often track short-term treasury yields. They also influence your investments. If the government bonds offer 5% guaranteed, and some investors will sell stocks, especially the risky ones, to lock that in return, the equity risk premium in action. Imagine you could buy a stock index fund expected to return 6% or a treasury bond that pays you 5%. That is a difference of 1%. The equity risk premium might not feel worth the risk to some investors. When that gap shrinks, money often flows from stocks into bonds. Corporate bonds and credit spreads. Companies also issue bonds, but unlike governments, they can go bankrupt. To attract buyers, they must offer higher interest rates than the treasuries. The difference between corporate and government bonds yield is the credit spread. When the investors worry about the economy, they demand higher rates for the companies, and that spread widens. How the bond market steers the economy. This isn't just about Wall Street. The bond market decides how expensive it is to borrow money. If borrowing is costly, fewer people buy homes. Businesses delay projects, and governments may cut back on infrastructure or services. All of this can slow down economic growth. The yield curve, normal versus inverted. The yield curve is a chart showing interest rates for bonds of different maturities. Normally, long-term bonds pay more because your money is tied up longer. An inverted yield curve is when short-term bonds pay more than long-term ones. This often signals that investors expect rates and the economy to fall. Historically, inverted curves have appeared before many US recessions. Why short-term rates matter more now? Because so much US debt matures quickly, today's short-term rates directly impact how much the government spends on interest in the near future. This makes the bond market short and incredibly important for policy and budgeting. A real-life scenario where bonds matter. In 2021, US mortgage rates were around 3% because treasury yields were low. By 2023, a yield jumped on 30-year mortgage rates across 7%, pricing many buyers out. Retirement investing. Pension funds use bonds to generate steady income for retirees. If yields are low, they must invest more aggressively in stocks, taking on more risk. Corporate decisions. A company thinking of building a $200 million factory might hold off it because it must issue bonds at 8% interest instead of 4%, because the higher the payment could hurt their profits. Government budgets. If the interest on the national debt rises by 1%, it can add up hundreds of billions to annual interest payments. Money that could have gone to education, healthcare, or infrastructure. The final takeaway. The bond market is huge, around 100 trillion, and it influences nearly every financial decision made by governments, businesses, and individuals. It said the cost of borrowing competes with stocks for investor money and acts as an early warning system for the economy. Stock might grab the headlines, but bonds, they are writing the rules of the game.